Have you ever wondered where money actually comes from? Is it all just printed by the government? The answer might surprise you, and it has everything to do with a fascinating and sometimes controversial system called fractional reserve banking. Today, we're going to demystify this concept and show you how banks, in a way, create money out of thin air. Let's start with a simple story. Imagine a brand new town with a single bank, and let's say I'm the very first customer. I walk in and deposit $1,000 in cash. Now, the bank has my $1,000 in its vault. I feel safe knowing my money is secure and I can withdraw it anytime. So far, so good. But the bank isn't just a storage box. Its primary business is to make money by lending money. Now, the bank manager knows it's highly unlikely that I'll come back tomorrow and demand my entire $1,000 all at once. People usually only withdraw small amounts for daily expenses. So, banking regulators step in and set something called a reserve requirement. Let's say the reserve requirement is 10%. This means the bank must keep 10% of my deposit on hand, just in case. In our example, 10% of my $1,000 is $100. This $100 is the reserve. What about the other $900? This is where the magic begins. The bank can now lend this $900 to someone else. Let's say a local entrepreneur, Sarah, needs a loan to buy new equipment for her bakery. She borrows the $900 from the bank. Now, let's pause and look at the money supply. I still have a bank account that says I have $1,000. I can write a check or use my debit card for that amount. But at the same time, Sarah now has $900 in cash or in her own bank account. Suddenly, the initial $1,000 has become $1,900 in the economy. 1,000 in my account, and 900 in Sarah's. That $900 was essentially created through the act of lending. It wasn't printed, it was brought into existence by the bank's ledger, but the story doesn't end there. What does Sarah do with the $900? She buys her new oven from a supplier. Let's call him Tom. Tom now has $900. What does Tom do? He deposits it back into the bank. Now, the bank has a new deposit of $900. And what does the reserve requirement say? The bank has to keep 10% of this new deposit. So it keeps 10% of $900, which is $90 as a reserve. And the rest, the remaining $810, the bank can lend it out again. Let's say another person, Mike, wants to renovate his kitchen. He borrows that $810. Now, let's check the money supply again. I still have my $1,000. Sarah has her equipment, and the supplier, Tom, has a bank account with $900. And now, Mike has $810 to spend. The original $1,000 has expanded even further. This process continues. Mike pays his contractor, who deposits the money, and the bank lends out 90% of that, and so on and so on. Each time a loan is made and the money is redeposited, new money is created in the system. This is called the money multiplier effect. In theory, that initial $1,000 deposit with a 10% reserve requirement could eventually create up to $10,000 of total money in the economy. The formula is simple: the initial deposit divided by the reserve requirement. So $1,000 divided by 0.10 gives you $10,000. This system is the backbone of modern economies. It allows capital to flow efficiently, funding everything from small business loans to home mortgages and large corporate investments. It fuels economic growth by ensuring that saved money doesn't just sit idle in a vault, it gets put to work. It allows people's savings to fund other people's ambitions, creating a dynamic cycle of investment and expansion. However, fractional reserve banking isn't without its risks. The most obvious one is a bank run. What if, for some reason, I and all the other depositors get scared and rush to the bank at the same time to withdraw all our money? Remember, the bank only holds a small fraction, the 10% reserve in actual cash. It doesn't have everyone's money on hand because it's been loaned out. In our story, if Tom, and all the subsequent depositors showed up demanding our cash, the bank would quickly run out. It would have the $100 from my deposit, the $90 from Tom's, and so on, but not nearly enough to cover everything. This is what happened during the Great Depression, leading to widespread bank failures. To prevent this, modern systems have several safeguards. First, there's deposit insurance. In the United States, the FDIC insures deposits up to a certain amount, currently $250,000 per depositor. This gives people confidence that their money is safe, even if the bank fails, which reduces the incentive to panic and start a bank run. Second, central banks, like the Federal Reserve in the US, act as a lender of last resort. If a bank faces a temporary cash shortage, it can borrow from the central bank to meet its obligations and stay afloat. The central bank can also adjust the reserve requirement itself. If they want to stimulate the economy, they can lower the reserve requirement, allowing banks to lend out more. If they want to slow down inflation, they can raise it, restricting the amount of new money being created. In fact, in recent years, some countries, including the United States, have even reduced the reserve requirement to zero for many banks. Does this mean they can lend out everything? Not exactly. They are still constrained by other capital requirements and risk management rules that ensure they remain stable. But it shows how central banks can use these tools to influence the economy. So, to recap, fractional reserve banking is a system where banks keep only a fraction of deposits as reserves and lend out the rest. This lending process creates new money in the economy through the money multiplier effect. It's a powerful engine for economic growth, but it carries the inherent risk of bank runs. Modern safeguards like deposit, insurance, and central banking help manage these risks and maintain the stability of the financial system. It's a mind-bending concept, right? that the money in your bank account is both a liability for the bank and a functioning part of the money supply, created not by a printing press, but by a simple ledger entry for a loan. The next time you see a bank, you'll know it's not just a building that holds money. It's an active participant in creating it. I hope this explanation made this complex topic a bit clearer. It's one of the most fundamental, yet often misunderstood aspects of our financial world. If you found this video helpful, please give it a thumbs up. It really helps the channel. And for more videos that break down the world of finance and economics, don't forget to subscribe and hit that notification bell. Thanks for watching, and I'll see you in the next video.